In this segment, we will talk about convertible bonds. You have seen them briefly in level 1, but now we need to understand convertible bonds in a lot more detail. This initial excerpt from the curriculum will remind you about what exactly is a convertible bond. So let's read this together. A convertible bond is a security that can be converted into common stock at the option of the investor. So note this word option. Hence, it is a bond with an embedded option where the option is granted to the investor. Moreover, since a convertible bond may be callable and puttable, it is a complex bond because the value of the bond will depend on how interest rates change, which affects the value of the call and any put option, and how changes in the market price of the stock affects the value of the option to convert the common stock. So in simple words, your convertible bond basically is a combination of a bond plus a call option on the underlying stock plus potentially a embedded option, which might be an embedded call or an embedded put. So we are combining several things here. Do you recall from level 1 what, in simple terms, how would you describe a convertible bond? Yeah, so where the holder of the bond has an option to convert it into X number of shares. Okay, now what that X is important, that we will get into. And the reason we are talking about embedded options is that very often these convertible bonds also are callable. Okay, so let's get into some details. I think the best way to understand convertible bonds is by looking at the example in the curriculum, which is very good. So they give you this convertible bond. So we have a convertible bond. The current market price is 106.50. Maturity date is 9+ years, and I'll explain why we have 9+. It's non-callable for 3 years, and the call price schedule is given here. So obviously first 3 years not callable, and then after that it's callable based on this schedule. Note that the call price decreases as we go further into the life of this bond. The coupon rate is equal to 5 3/4%. The conversion ratio, and this is the first new term that you are seeing, is 25.320 shares of ADC. So that's the company that's issued this bond. So 25.32 shares of the company per $1,000 par value. So the par value of this bond is 1,000. When you buy one bond, you have the option to convert it into 25.32 shares. So what's 25.32? It's the conversion ratio. Is this information written on the bond legal document? This information? What do you think? Yeah, it is a convertible bond, so this information is given. Is the coupon rate written on the bond? Okay, the par value is written on the bond. We are told that the rating agency has given this rating. And then we are also given information about the stock. We have expected volatility of the stock is 17%. The dividend per share is 90 cents. Current dividend yield is 2.727%. What is the dividend yield? What's the definition of this? Yeah, it's the expected dividend divided by the current price, and we are given the current stock price. Okay, one of the challenges when we talk about convertible bonds is to remember a whole bunch of terminology. And the reason I'm doing this here is I'll try to help you memorize the terminology. The concepts are not hard. So the first term that you've learned is conversion ratio. Yeah, so as a refresher, if the conversion ratio is 25, that means that for one bond, you have the option of getting 25 shares. So that's conversion ratio. Next term that you need to memorize is conversion price. That's the bond price divided by conversion ratio. So what do you think is the significance of this conversion price? In our example, what's conversion price? What's the bond price? We are told that bond price is 106, but actually I think strictly speaking this should have been 106% because the par is 1,000. So what is the actual bond price? It's 1065 divided by conversion ratio, which is 25.32, which is what? 42.06. What do you think is the significance of this 42.06? If you are trying to get your hands on these 25.32 shares by buying the convertible bond, effectively how much are you paying per share? 42.06. So the point is, if you directly buy the shares in the market, they come for 33. But if you try to get the shares by buying the convertible bond, then the price per share effectively is 42. So that's why this is called the conversion price, because you're buying the bond possibly with the intent of converting to shares. So this effectively is the conversion price. Okay. Now, I'm going to say things that are essentially planting hooks in your head right now so you can remember. Later on, later in this presentation, you'll see this again. But is it intuitive that the conversion price is more than the market price? Why? Yeah, so the simplest way of looking at it is by paying this premium, you have the option of buying the stocks if the stock price starts going up. And in the meantime, you have the bond, so you will get the reasonably good coupon rate of 5 3/4 while you hold the bond. So it makes sense that this price of 42 is more than the current market price. Okay, let's keep going further. Now, one of the basic points is about the pricing of this bond. What is the minimum price of a convertible security? Okay, the minimum price is actually the greater of these two values, the greater of conversion value and straight value. What is the conversion value? It's the stock price times, what was this number? The conversion ratio. So is it logical that that convertible bond, so this convertible bond, which is giving you a coupon of 5 3/4%, what else is it giving you? It's giving you the right to get about 25.32 shares. Okay, so at the very least, this bond should be worth 25.32 multiplied by the current share price of 33. So that is called the conversion value. So this you can think of as a floor. Okay, another floor essentially is the straight value of the bond. So if this bond did not have this conversion option, and you did a valuation of this bond given the current interest rates and given that it doesn't have the conversion option, and you come up with a price of 98.19, is that a base price? So think of it this way. So if you have this bond which is exactly the same, but it doesn't have the conversion option, and without the conversion option the bond is worth 98.19. Now I give you a conversion option on top of that. Is the bond worth more? It will be worth more. So this can also be thought of as a floor. So when you have two floors, which floor takes effect? The higher floor. Okay, so the way it is described in the curriculum, the minimum price of a convertible security is the greater of conversion value and straight value. In this particular case, since straight value is higher, that represents our minimum price. Now, does this mean that the bond will sell for, the convertible bond is at this price? No, it's simply saying that it's at least this price. In the market, can you expect it to be more than this? Yeah, because we have a conversion option. Okay, continuing with our terminology, some of this you've already been introduced to. So what's the market conversion price? It's the market price of the security, which is 1065, divided by conversion ratio, which we've already calculated as $42. Okay, so again, just to make sure you are with me, what is the interpretation of this 42.06? Yeah, so this 42 represents effectively how much you are paying per stock if you are planning to buy the bond and then convert it into the 25.32 shares. Okay, the market conversion premium per share is simply the market conversion price of 42 minus the current market price, which is 9.06. Okay, so that's your premium. By buying the convertible bond, which is giving you the comfort or the safety of a regular coupon payment, you are paying more per share than the current actual share price. The amount that you are paying more is 9.06. What's the term for this 9.06? It's the market conversion premium per share. And this is an absolute number. If you want to express it as a ratio, the market conversion premium ratio is simply the market conversion premium per share divided by the market price of common stock. So essentially, we are paying a 27.5% premium when we go for the convertible bond. Okay. So what's the current income of a convertible bond versus a common stock? Which one do you think will be more, the income from the bond or the stock? Typically, bonds give you a higher income. Now, there is this concept of a premium payback period. What does this mean? When you buy the bond, the convertible bond, okay, you are paying a premium. What's the premium that we just calculated? It was the $9. This was on a per share basis. The additional amount that you are paying on a per share basis by going for the convertible bond, that premium was 9.07. Now, payback that you might recall from level 1 corporate finance is how many years it takes you to recoup that investment. On a per share basis, basically you need to look at what is my favorable income differential per share. Okay, what does that mean? When you have a share, what's your income? It's the dividend per share, right? Okay, when you have a stock or a bond, what's your income? It's the coupon. So the way you can look at it, where do we come up with this favorable income differential of 1.37? I hope everybody knows now where we came up with the 9. So the question is this favorable income differential of 1.37. This effectively is the coupon interest. What's the coupon interest? 97.50. Where do you think this came from, this number? Do you remember the coupon rate? 5.75% of the par value. So that is this number. So that's our income from the bond minus the conversion ratio multiplied. So what is this number? Conversion ratio, this is 25.32 multiplied by the common stock dividend per share, which is given as 0.90. So this is for one. So this number is the income that you are getting from all 25.32 shares. So on a per share basis, you simply divide by the conversion ratio, which is 25.32. So what does 1.37 represent? This is the extra income on a per share basis that you have by owning the convertible bond rather than the stock. Okay, so our payback period is 6.6 years. Okay. Now, what's the downside risk with a convertible bond? Just at a high level, if you have a choice between a convertible bond and a stock, where is the downside risk more? The downside risk with the stock is more because if the market goes bad or there are some issues with that particular company, the stock price can go down a lot and it can go down very fast. Typically, bond prices don't go down as much. So the one measure, a somewhat faulty measure, but a measure nevertheless of your downside risk is the premium over straight value. What does this premium over straight value mean? So let's understand this. What is 106.50? That's the current market price of the convertible bond. What's 98.19? That's the straight value. That's what the price of the bond would be if there was no conversion option. So that additional premium over 98.19 is 8.5%. So to check your intuition, the higher this number, the more the downside risk, or the lower this number, the more the downside risk? Mubin? Yeah, if this number is very high, that means that you are paying a very high premium for the convertible bond, and so the downside risk is more. If this number is just marginally over, if your market price is just marginally above straight value, then the downside risk is relatively low. What's the flaw with this measure? The flaw is that straight value is essentially considered fixed, but what happens if interest rates go up? What will happen to the straight value? It will go down. So from an exam perspective, just recognize that's the core flaw, and the way the curriculum puts it, despite its use in practice, this measure of downside risk, which we just talked about, is flawed because the straight value, i.e. the floor, changes as interest rates change. If interest rates rise, the straight value falls, making the floor fall. Therefore, the downside risk changes as interest rate changes. Okay, but still, it's a reasonable approximation. What's the upside potential of a convertible security? Where do you get upside? If the stock price starts shooting up, then will the value of the convertible bond go up? Yeah. Will they go up at the same rate? So if the stock price increases by 6%, will the convertible bond also increase by 6%? No. More than 6%? Less than 6%? Actually, less than 6%. Okay, and we will look at that. So just the intuition I want to put in your head is, when you think of risk and return, the way you can think, do you think a convertible bond has more risk than a stock or less risk than a stock? Less risk. So that means the upside return is going to be less, and the downside risk is also going to be less. So with a convertible bond, you are taking less risk, and therefore it would be reasonable to expect lower return. Okay, I think this is a good read. It summarizes things well. The investment characteristics of a convertible security. I'll just read this and then summarize it for you. The investment characteristics of a convertible bond depend on the common stock price. If the price is low, so that the straight value is considerably higher than the conversion value, then the security will trade much like a straight security. I think if you can go back to your options days, you can, and I'll tie this to options later. If an option is way out of the money, then it's almost worthless. So if the price is low, so that the straight value is considerably, if the price of what is low? The price of the stock is so low that the straight value is considerably higher than the conversion value, the security will trade much like a straight security. That's because the stock is not playing a role. The convertible security in such instances is referred to as a fixed income equivalent or a busted convertible. Okay, the latter sounds more interesting. Okay, when the price of the stock is such that the conversion value is considerably higher than the straight value, then the convertible security will trade as if it were an equity instrument. In this case, it is said to be a common stock equivalent. In such cases, the market conversion premium shall be very small. Between these two cases, fixed income equivalent and common stock equivalent, the convertible security trades as a hybrid security, having the characteristics of both a fixed income security and a common stock instrument. I think this is reasonably self-evident. Okay, now how do you value this creature? Okay, that has all sorts of attributes. Okay, fortunately for us, we don't need to get into details. We just need to understand at a high level. Once you understand derivatives, then you can come back and actually use some of this material. If you have a convertible security that is simply a straight bond and a conversion option, you know how to value a straight bond. And you don't know this yet, but after doing derivatives, you will also learn how to value a call option. So as we've discussed, a bond with a conversion option is effectively bond and a call option on the underlying stock. So if you can value the bond, the straight value of the bond plus the value of the call option on the stock, then you have the convertible security value. So the sort of question that you might expect on the exam, if everything stays the same except the volatility of the underlying share, what will happen to the value of a convertible security? It will become higher because, as you will learn in derivatives, the value of a call option becomes more when the volatility of the underlying stock goes up. Okay, now let's add one more wrinkle. Let's say that the bond is callable. The case of the bond that we are looking at in the convertible bond from the curriculum is callable. So what does an embedded call option do to the value of the bond? The embedded call option is not good for an investor, so you subtract the value of the embedded call option. And we've discussed how to value that. What if the bond also has a put option? Then you add the value of the put option. Okay, and finally, this is the last slide in this segment. Okay, I'll have you read this later, but I'll just hammer in the core point. Essentially, what we are doing here is taking that same bond that we've talked about, okay, and we are looking at, so let me read this. Comparison of a 1-year return for ADC stock and the convertible issue for assumed changes in stock price. So we are saying that if we are sitting on 7th October 1993, and what if the stock price goes down by 25%? Then the ADC stock return, so if the stock price changes by 25%, then the ADC stock return is, I need to double check why these two numbers are different, but I'll just make the larger point over here. The point is, if the stock goes down, then the value of the, if you take the stock goes down by a large amount, then the value of the convertible bond goes down but by a small amount. When the stock went down by this much, if the stock loses 7.2%, then actually the bond gains slightly. So the point is, stock going down a lot, bond goes down just a little bit. Okay, what if the stock goes up a lot? Then the bond goes up but by a little bit. So that is actually the core point. So having a convertible bond gives you downside safety, where if the market tanks, the stock goes down, you don't lose as much, but you also have limited gains on the upside. If the stock goes up a lot, your bond doesn't go up that much. Okay, so that's it. We've completed this reading.